What's up, my fellow wealth creators? Matty Ice here. Welcome to another episode of the Millennial Wealth Creator Podcast. I am joined by my friend Barry James Dyke once again for part 2 of our conversation. Barry, welcome back to the podcast and the channel. I really appreciate you being here, man.
Well, thanks, Matt. Thanks for what all you do, and we need the next generation needs to know what's going on, and 100%. So we can clean up the mess which has been left behind. You know.
Yeah, I think that's putting it lightly, my friend. So, guys, just so you're aware, Barry and I had a really good conversation last week. I'll link that episode down below. We talked about his book, really breaking down his book, Pirates of Manhattan. Again, if you guys do not have this book, you have to get it. It is a phenomenal book. Goes through, and this is kind of a lot of what we talked about last week about just the corrupt history of Wall Street and how the things that we're taught when it comes to building wealth and how we're just kind of we're somehow convinced that we should hand over the majority of our money and the majority of the wealth building process over to Wall Street. It's not set up in our best interest whatsoever. And are there some things that we can use to our benefit and take advantage of? Sure. But in general, we want to be really careful when it comes to passing off the responsibility of our personal finances over to Wall Street. So we had an entire conversation about that. And the book breaks down the corrupt history of Wall Street. And it's just like, you got to be really careful where you're putting your money, but it also does a fantastic job of comparing that to one of the things that, one of the primary things I talk about on this channel is using mutually owned life insurance companies with, cash value dividend paying life insurance, implementing infinite banking and stuff like that. It does a great comparison of that. And that's actually what we're going to talk about in this episode is specifically infinite banking, because Barry actually had the honor and privilege of knowing Nelson Nash, who wrote the book on infinite banking. It's called Become Your Own Banker. I highly recommend that book as well. So he knew Nelson Nash for a long time. He implements infinite banking himself. And so we're just going to have a conversation about our experience with this really, really powerful financial strategy. And hopefully it'll give you some context about, or the information you need anyways about how it works so you can determine whether or not it's a good fit for you. It's certainly not a good fit for everybody, but I do think everybody should at least explore it, because how do you know if it is or not unless you do the research, right? So that's what this conversation is going to be all about. We're going to cover our experience, our favorite benefits of infinite banking. We're even going to address some of the common objections and answer some of the most common questions when it comes to infinite banking as well. So you do not want to miss this episode. This is going to be some really, really good stuff. All right, because I can tell you what, guys, infinite banking changed my life. I've been implementing it for about 3 years now, and I can't imagine doing anything else when it comes to building wealth. And one of the reasons is because it just perfectly aligns with what I'm trying to do, right? Again, it's not for everybody, right? But this thing has changed not just my life, but also the lives of some of my friends and family as well. We'll get into that later. But Barry, let's do this. Why don't you kick us off with your experience with infinite banking? So you met Nelson Nash a long time ago. Obviously, he introduced you to that concept. So talk to us a little bit about how you met Nelson Nash, what that conversation and relationship was like, and then your introduction into infinite banking.
Sure. And it's a pleasure to be on and share this with you, Matt. I met Nelly. We used to call him Nelson Nash. People he was dear to us. We used to call him Nelly. And the thing is the and I was very, very blessed to have a very good intimate relationship with him. And but I had a background and I hope this light's flickering on here, man. I'm just trying to deal with this here. I know what it is. Hopefully, let's see. So I met Nellie Hoji was about 20, 25 years ago, and I was going through a very rough time during my personal life, and I always had to reinvent myself, and I had been fortunate enough because I had a benefits business, a pretty successful benefits business at one point. I actually did benefits for, a lot of privately held companies, but even some major public companies. And I owned an administration firm. And so I knew a lot about benefits. And 401ks. Actually did one of the first 401ks and one I knew about. Was over 30 years ago. And, and I was always very entrepreneurial, and, I was going through a tough divorce at the time. And I intuitively knew, and I just intuitively knew, and I had a pension business, Matt, and I still do pensions to this day, but I intuitively knew at the time that people who had money in retirement plans, it was very difficult for them to make money in the markets themselves. And then at the time, and if you had a lot of money, it was the worst place to have your money, because it could have been actually taxed as high as, almost 90%, because at the time, the unified credit in estate taxes, this 25 years ago, was only $750,000. And there was also success tax. So if a person had $1 million in a qualified plan, and they were wealthy enough and they had real estate and other assets, they could be taxed as high as 95%. So that was credible. But I intuitively knew, because having a pension business and doing administering 401ks, profit sharing plans, and I still do some of that work to this day, I knew it was very difficult for people to make money. But I said, who's making all the money? So I intuitively knew who was making the money in this. I mean, it's Wall Street, it's the asset managers. There's nothing, and this is who dominates the narrative today. Because the old days, people would have pension plans and so forth. So I knew a lot of these financial products didn't work. And then I was also blessed because I also had another great mentor, a guy named Robert Castellone, founder of Leap Systems, who I'm still friends with to this day. And Bob is, I don't know, 85, 86, whatever, but he's still sharp as a tack. But so I knew from a mathematical perspective that a lot of these retirement plans, 401ks, they really didn't work. It was a bunch of bullshit. And so it was Bob Castle who showed me really from a mathematical perspective how all these products which were being sold to us, like dollar cost averaging and all things like that, were a bunch of hooey. There was no really scientific proof to them. And so I knew that. But then I got to know, but when I understood that everyone needed to have warehouse capital, I understood that really is one of the best things anyone could do. So then I get to know Nellie, and I was at the time, I had a lot of time on my hand. I was doing a lot of research, and I started running to where the very wealthy put their money, where banks put their money. And at the time, no one would talk to me about this. And I used to go to Birmingham all the time, and used to have this symposium, but I don't know what you think tanks. And I would go down there and I presented some of my information, and I stumbled into some stuff and about how banks own the life insurance. And then I shared it with Nelson. He says, he said, Barry, you have to finish this work. And so I did. And that's how the first book, the Pirates of Manhattan, came out. And this was also the time of the 9/11 tragedy, Matt. And this is when I discovered that when the World Trade Center, they paid out $6 billion in life insurance benefits, and it was all based on the human life value. So everything which I intuitively knew about the benefits of life insurance and warehousing cash, I was the guy who essentially I found out where Citigroup and Bank of America and all these banks put all these billions and billions of the dollars, even to this day,
right,
for their own account and with life insurance companies. And so I knew so. And then we realized the benefits as a tool. What's the best tool could it be? And again, I'm not against investments. I'm a capitalist, okay? But if you look at, there's only so many places you can put money in a society. You can put it in the market, okay? And that guarantees nothing. As they tell people, the 401ks get more. A toaster from Walmart has more guarantees than a 401k, and I still stick to that today. You could put your cash in a mattress and get stolen. You could put it into a small business, which you're doing and I do, and which is still a good rate of return overall. But when you put money to a small business, it's highly illiquid. You can put it in real estate. Nothing wrong with real estate or businesses and things like that, which is a really good thing to do. Or you could put it into a like a life insurance policy, something of that nature, a commodity, whatever. So there's not all that many. When you really look at where you put your money, there's not that many places you can put it.
Right.
So when you start analyzing it, life insurance or like whole life in particular, it's a bloody economic workhorse, and it can do so much for people. And the best investment is always going to be in yourself, Matthew. I always tell people, and I tell people. Somebody asked me yesterday, James Nethery, a friend of mine, asked me the other day on a podcast. I still believe in my faith is number one in my life. My family is number two. My friends are number three. My physical fitness is number 4. 5 is finances. So, but anyway, so whatever God's put on your heart, you're going to do. But you're always going to have a source of capital.
Mm-hmm.
And the thing is that you need, and the more time when you have capital in the bank, which I do, or in my policy, and I have a good chunks of it. Okay, it's really nice. You can finance your own stuff. You don't have to worry about the banks. Because the banks don't give a shit about you. All they want to do is they want to sell you credit cards and make outrageous money on and usury interest. And this, by using the banking concept, you can help people take more of their control of their financial lives. Okay, now it's not an overnight solution. Okay, like anything, sure. Matt, like in sports, or if you're going to be a good guitarist or a good teacher, a good surgeon, whatever, everything takes discipline and practice. Okay, so
right. It's a process.
So I have hundreds of thousands in my policies because I'm working at it for a while. Okay,
right.
And everyone can. But the thing is, it's really, really nice to say if you can buy anything you want. I can go out and buy the nicest sports car, and I happen to like Porsches. Okay, so I can go to any dealership, buy
not a bad choice.
Myself, and buy a Porsche and finance it myself.
Right.
So
through your policy.
But when you understand the mechanics of it, if you do it correctly, you get rid of the lost opportunity cost.
Yep.
You're also protecting your family. You can have disability benefits in case you become disabled. If you're in a great state like the state of Florida, in case you get sued, I don't know if you know this, but all life insurance and annuity assets are 100% from the claims and creditors in the state of Florida.
Right.
So it depends.
Protection.
Because stuff happens. And people die all the time. Yeah, I just had an old friend of mine. I just found out that this morning that he died yesterday. So the thing is that none of us are going to be around forever. So what I'm saying is that when you look at all the things it can do, it's like the Swiss Army knife of products. The problem is that I see this now, and I'm not really on top of it as much as you are, but I'm seeing all these bastardizations now using universal life, equity index universal life to do the infinite banking concept, and that's bullshit because unfortunately you're giving the company back too much power. So you really want to have this capital as much as you possibly can for yourself, and and that's how it kind of works in my life today.
Right. There's a lot of really good stuff. What's up, my fellow wealth creator? Pardon the quick interruption. I hope you are enjoying this podcast episode. I really appreciate you tuning in. I wanted to just real quick remind you about all of the really awesome, powerful tools, training, resources, etc. that I have for you in the description. I want to make sure you take advantage of it. These are things that have made such a profound difference in a significant impact in my own wealth building journey, and I want to share that with you guys. So I have all kinds of different masterclasses. I'm finishing up my Millennial Wealth Creator University as well. So make sure you check out all those resources and take advantage of them because they made such a huge difference in my life. So with that said, thank you again. Enjoy the rest of the episode. We can unpack there. I do love that you called it the workhorse of financial products. I've heard that term too, the Swiss Army knife of financial products. And what we're talking about here, there's a difference between infinite banking and dividend paying whole life insurance, guys. All right. So infinite banking is the strategy itself. It's how you utilize the asset that we use to implement something like infinite banking. And that asset is an overfunded dividend-paying whole life insurance policy. As Barry mentioned, it's not index universal life. Okay, I've done lots of videos on that. And here's the thing. If you want to try to implement infinite banking with an IUL, you could, right? But the my pushback against that, the way that I explain it anyways, is just because you can do something doesn't mean you should. Okay. I can cross the street during 5 o'clock traffic and not look both ways before I cross the street. I could do that, but should I do that? No, because I'm probably going to get run over. Okay. So it's very similar with an IUL. And I think the reason that people, and we'll get back on track with like how we use our policies here, but I do think this is important to address because IUL is spreading like a freaking wildfire right now and people are getting wrecked financially because of it, trying to implement something like this. And this strategy was never designed to utilize something like IUL. All right. But the extra potential percentage points of growth, which might be 1 or 2, like assuming that everything goes right in your IUL, you might get 1 or 2 extra percentage points of growth in the policy. But to me, that's not worth the risk that you are taking. Okay. Now, if you were going to earn like an extra 5, 6, 7 points, maybe. Okay. But the amount of risk you're taking in an IUL compared to the additional reward that you could get, it's not even a guarantee that you could get over a whole life policy. It's not worth it. In my opinion, if you want to do it and you understand how it works, God bless you. All right. We're capitalists here. You could do whatever you want. Okay. I don't care, but just be prepared for the consequences. All right. So IUL, just, we don't recommend it. Okay. With that said, I want to get back to the like all the benefits that we get from this. And we're going to start to talk about some specific ways that we use infinite banking. But here's the thing. Here's what's really interesting about dividend paying whole life insurance. Like, even if you didn't implement something like infinite banking, like if you didn't start self-financing, if you didn't use the policy to build wealth, whatever, and you just had the whole life policy, it provides so many benefits. It solves so many problems within one asset. Right? Barry alluded to some of them earlier, right? You have the financial protection for your family in case you pass away, and that will be there for you for your entire life. You don't even have to pay into the policy your entire life. You could pay into it for 10 years, 20 years, whatever. It doesn't matter. But that policy will continue to grow. The death benefit will continue to grow. It's going to be there when you actually need it. It gets passed on income tax free to your loved ones. It's a massive, massive legacy play. Right? The cash value is going to continue to compound in a tax advantaged manner, in a tax advantaged environment. You have the chronic critical terminal illness riders in case you get sick. I actually know somebody that's just a couple of years older than me. He's 40 years old. He was just diagnosed with non-Hodgkin's lymphoma at 40 years old, guys. And, I'm seeing like all the GoFundMe pages and stuff, which it's great to see the community come together and support them. But I can't help but feel sad and just also really frustrated because we're told our entire lives, stay away from whole life insurance. It's the devil when it comes to financial products. And it's just bullshit, man. It's like, this is an amazing freaking product. And if he had access to those additional financial resources through those chronic critical terminal illness riders, he would have a sufficient amount of capital to get the care that he needs and prevent this situation from potentially bankrupting his family. Like it's horrible, right? So my point is, we get all of these benefits, not even implementing infinite banking yet. All right. We're talking about a really, really solid foundation for our personal finances, a great place to save and store capital. And then if we want to take advantage of wealth building opportunities, if we want to self-finance our large purchases, then we can do that. All right. But starting with the financial foundation, man, I think it's so important, and it's very much overlooked. And I think when these financial gurus out there are talking about how whole life insurance is a terrible investment and stuff, they're really doing people a very big disservice because they're only telling half the story. Like, if you do just a traditional whole life policy, is it a great place to store money? Probably not. But if you design it right for something like infinite banking, it can be freaking amazing. Guys, like the equivalent of a high yield savings account with so many more benefits. Like, and once
did we talk about the
things work? Go ahead.
Did we talk about the Mickey Mouse plan?
Yeah, last episode, the Mickey Mouse plan with Walt Disney. Yeah. So how he used his policy to start Disneyland. That was a big part of like all the financing for it. Yeah, that was interesting. Yeah, this stuff has been used for a long time.
It's been used for a long time. And then the whole thing, which you understand, this will be coming in the next books, which I'm releasing this fall, is when it comes to how can I put it? The discipline of savings and is more important than the rate of return. And chasing rate of return is goofy. And if you're going to be in the market, it just people just don't know what's going to happen. We don't know what's going. I don't know what happened for dinner tonight. Never mind what's going to happen next week or next year or whatever. We just don't know. So when you understand that and things happen. So when you understand that, what's the most important thing? Well, if you want to buy a car, what's the most important thing? Is capital. You want to buy a home, what's the most important thing? Is capital. You want to buy a computer equipment. I mean, I remember using infinite banking one time. The first time I had to buy, I don't know, 10, 15 years ago, I had to buy all this computer equipment. And this is it. And, it was awesome. And, I had to pay spend at the time about $20,000, $30,000, more than $30,000 in computer equipment. And I could finance it myself. Now I paid it all back. But the whole thing is I had it immediately. And
Barry, let's dive into that really quick, okay? Because I could hear questions that people probably have about that. The question would be, why would you use a whole life policy to buy $30,000 of computer equipment? Like, aren't you borrowing your own money? You're paying interest to borrow your own money. Like, why does that make sense? Let's actually break that down. I think that's a really good example to demonstrate the power of infinite banking. Okay, so here's what's interesting, guys. When Barry took his policy loan, okay, to finance the equipment, or to purchase the equipment that he needed, there's a lot of things happening. Okay, number one, his money, his cash value is still compounding in the policy, untouched. Okay, because he takes a policy loan from the life insurance companies, not using his own money. He's using the life insurance company's money. All right, so this argument that I hear sometimes where you're paying interest to borrow your own money. You're not. You're borrowing the life insurance company's money. Your money continues to grow, to compound uninterrupted, tax-free in the policy. Okay. Versus imagine. So let's flip the scenario here really quick, Barry. Imagine if you saved the $30,000 in a bank account, okay, and then paid cash out of the bank account to buy the equipment. Well, how much interest are you earning in your bank account now? Goose egg, zero. That's called lost opportunity cost, guys.
Yes.
Okay. And when you run the numbers on this, Barry, I saved over $100,000 by purchasing my vehicle through my whole life policy over the course of my lifetime. I saved over $100,000 in lost opportunity costs because my money's continuing to compound versus if I pay. How are you normally taught to buy a car? It's either financing or if you can pay cash because you don't want to pay interest, right? Well, you actually are paying interest. You're not paying interest to a bank. You're losing out on the interest that you could earn over your lifetime. So if Barry had taken the $30,000 in a bank account, just paid cash, well, that $30,000 is no longer earning interest for him anymore. So instead, what did he do? He puts it into his whole life policy first, where it's going to continue to compound. He borrows against it. Yes, he's going to pay a little bit of simple interest on the policy loan, but that's a very small price to pay to continue to get that uninterrupted compound growth, not to mention all of the other benefits as well. Okay. When I hear that, Barry, that's how I interpret what happened. Do you have any thoughts on that at all?
Well, yeah, and the whole thing, but the key is it's got to be in the discipline, Matt. In other words, is that if you're leveraging your insurance as you should, doing it properly, you have to, as they'll say, you can't steal the peas. You gotta pay the loan back. I mean, just like you were paying Chase on a car loan or whatever. And if you look at it, say, for instance, I don't know. For instance, I like nice cars, but I never buy them brand new. I
me neither.
I'm too cheap, but I like nice cars, okay, and I have some nice ones. But the thing is that if you a used car loan now is like 14%, 15%, something like that. And even if you're,
I was quoted 10% with decent credit. I was quoted 10%.
And 10%, and so what I'm saying, when you understand that, how much more leverage you can do it yourself at 5, 6, 7%, whatever the case may be, and you're in control. That's the beauty. The thing is, you're driving the whole vehicle and not the bank, because if you say you have to skip a payment, whatever, things happen, life happens to all of us. If you have to stop paying back the life insurance loan for a couple months, you can do it.
Right.
You think you can
that's awesome.
You think you go to Bank of America and say, "Hey, I don't want to pay my car note anymore." Before you know it, within about 30 days or 60 days, someone's gonna be jumping over your fence and trying to steal your car.
Right. They're gonna put a private investigator on you at that point. Let's dive into that part. I'm so glad you brought that up, because I think that is an often very, very overlooked benefit of self-financing through a whole life policy, specifically something like a car, because you're exactly right. The control that you have of making those payments back, which you mentioned, which is so important. You absolutely want to pay the policy loan back, just like you would a regular loan from a bank or whatever. Okay. You're paying your loan back just like you would anywhere else. Okay. The difference is you're in control. There are no specific terms and conditions other than the interest rate, which is oftentimes going to be less. Many times it's less than what you'll get from a traditional bank loan. Okay. So you're already paying less interest there. But also, like you mentioned, if you fall on hard times, if cash flow is tight,
it happens. It happens.
Life happens, man. You think you're going to call up Bank of America or Wells Fargo and say, "Hey, I can't make my car loan payment for 6 months." Okay. So there's going to be penalties, additional interest, additional costs. They might not even work with you, right? They might even like repossess the vehicle, right? It's going to hurt your credit. There's all these consequences if you don't stick to that payment schedule. But when you borrow against a life insurance policy, take a policy loan, if you need to take a break for 3 months while cash flow is tight until you get back on your feet, it doesn't hurt your credit. There's no penalties. Nobody's harassing you for payments. You don't have any collection agencies calling you. You don't have to worry about someone coming to repo the car, because you technically did pay cash for the vehicle. You own it outright when you self-finance through a policy. You're just paying the policy loan back. Okay. But there's no, you didn't put up the car as collateral for the policy loan. So guys, I can't stress this enough. It gives you so much flexibility and control over your life, everything that's happening within your personal finances. And, Barry, you mentioned it earlier where, you have to build up to it, right? Like not everybody's going to be able to put enough into a policy right away to purchase a car. That's fine. You got to get started somewhere. But man, once you are at that point, guys, oh man, you kind of start to exit the system a little bit. You're less dependent on Wall Street and banks and stuff.
You're getting that, it was in the Bible says the borrower is the slave to the lender, and you're getting and because finance now, I've been in finance so long, it's so predatory, and the whole thing is that this is a really honest system. Now the whole thing is when you look at all the finance systems out there today, if it's done right, again, it's all boils down to discipline. But if it's done right, it's really one of the only honest systems in finance in America today, bar none. I mean, because when you understand, I mean, with their like 401k investments, they would put. Actually, you can put cryptos.
Cryptocurrency
now. If you with Infidelity or BlackRock, okay, which to me it just is criminal. Now they want to put alternative investments, which is private credit, and you know what private credit means, man?
Private equity and stuff.
Private. It means everything's done in secrecy. You know nothing. At least with a bond is a public bond. You know what the coupon is and what's the listing, the whole thing. When it's private, that means everything's done in secrecy. Okay, so the last thing people need is in finance today is more secrecy. So when you understand the mechanics of the infinite banking system, it's beautiful.
Yep. You're in control, and you have your money stored in an asset that has been time tested for centuries with a company that has weathered every financial disaster that this country has ever experienced for over the last 200 years, I would say, to clarify. Okay, they've never missed a dividend payment. They are the strongest financial companies on the planet, right? It's like you're really getting the best of every aspect of a wealth building plan here, where you're partnering up with these massively successful companies that have never missed a dividend payment. You know, you're getting so much control back over your money. And here's the thing, guys, there's no right way to, well, okay, let me clarify. There is a right way to do it where you need to be responsible. Okay. Like if you're bad with money, infinite banking probably might make things worse for you.
Yeah.
Disciplines. All right. But here's the thing. If you don't want to, like for example, one of the things that I do, I use my policy to accelerate the wealth building process in my life so I have money in my policy and then I'll borrow against it at 6%. And then I lend it to my investor at 13% plus a point to do a real estate deal. And I'm the lender I've got the mortgage, the note, all that stuff, right? I'm literally the bank. Okay. You don't have to do that. If you just want a safe place to store capital in a tax advantage environment, it's going to compound for the rest of your life. It's going to allow you to finance a family vacation. It's going to help you finance a vehicle. Maybe you're a business owner and you want to start to reduce your dependency on third-party lenders. All right. So if you have cash flow every month, this is phenomenal for business owners, and you want to start to self-finance equipment purchases, marketing, advertising, payroll, whatever. Okay. Again, as long as you're disciplined with it, this will be a game changer for you because you're recapturing the majority of that wealth again. Because and here's another thing. When you pay that policy loan back, guys, it's just like a line of credit. That is immediately available in cash value for you to use, again, like a line of credit. Okay, so you're paying that policy loan back. That money is instantly available to you once again. Okay, so like this is incredibly powerful for business owners, but there's no like one specific way you have to implement infinite banking. It comes down to what you are trying to accomplish. What's going on in your life? Is there an emergency? Did your roof just collapse and you need $15,000, right? Assuming you have it in the policy, you could use your policy to do that instead of paying cash or instead of getting a very expensive loan, whatever, right? It gives you so much more control over your money, and it recaptures so much of that lost opportunity cost that, I don't know, like, we said in the beginning, it's not really for everybody, but I think everybody should at least explore it, because I can't imagine a scenario where somebody would not benefit from this, assuming that you could save money on a regular basis and you're disciplined. But if you meet those two things, those two criteria, infinite banking could more than likely benefit you, right? Because it's so powerful. And actually, I think that's a good transition, Barry, where this is one of the things I wanted to talk to you about. One of the major pushbacks that I often hear regarding infinite banking, it usually comes from people who are advocates of buy term and invest the difference, investing in the market, right? Building this, buy term insurance, then you build your portfolio. And I suppose there's nothing necessarily inherently wrong with that, I guess. Is it the most efficient and effective way to build wealth? I don't think so, but you do what you want. But here's the thing. This is often the argument, is you don't buy whole life insurance because it's too expensive. And what you're going to do instead is you're going to buy term insurance, and then you're going to take that difference between what term insurance and whole life insurance would cost for the same death benefit, and you're going to invest that. Now,
you're right.
The majority of people don't buy term and invest the difference. They buy term and spend the difference. That's a different conversation. But here's the thing. I don't understand why we can't do both. Okay, because if you think about it, so Tom Wall actually talks about this a lot. He talks about how dividend paying whole life insurance is a really good bond alternative, right? It gets similar internal rate of return with way more benefits. So here's the question, is if you were to just reallocate a portion of what you're putting into bonds, which is arguably not a really good thing to put money into anymore. It's not financial advice, but bonds are getting wrecked lately. But let's say we took some of that money and put it into dividend paying whole life insurance instead. You could still invest in the market. Like, you don't necessarily have to choose one over the other. You could do both, right? You put your bond money into whole life insurance, invest whatever else into the market if that's what you want to do,
Yeah.
Why can't you do both? I don't understand.
Why not?
What are your thoughts? What are your thoughts on doing both, Barry?
I think it's great. I mean, you don't want to be, because as we keep going down this crazy world of finance which we're in today, which inevitably results in money printing, Matthew. I hate to say it, but the inevitable price of assets, particularly real estate and securities and things of that nature, they're going to continue to go up because they're flooding it with cheap money. So to say we shouldn't be we should be considering that premium we're getting to put some of our money at risk. All I'm just saying is that you need to have a foundation, okay? And the problem is in America, and I don't know if we discussed this the other day or not, but the problem is that we don't save in this country. The problem is the debt. I mean, the thing is we don't borrow and save. We don't. How can I put it? We don't save. We borrow and spend. And I always tell people, even politicians, what's the difference between Democrats and Republicans? And I'll say this to anyone: Democrats tax and spend, Republicans borrow and spend. What's the difference? Okay, they're out of control. Okay, that means we have to have control of ourselves. Okay, and be disciplined. So the whole thing is really, I can't emphasize enough, is the importance of having good habits first, and then you'll have more opportunities.
Right. 100%. And I think with with something like whole life insurance, okay, going down this, maybe you're starting to go down this journey of infinite banking. It starts with the foundation. Okay. I think that's we talked a lot about this. We touched on this quite a bit in the last conversation, so I won't beat a dead horse. But the thing that one of the major benefits we get of dividend paying whole life insurance, because it is the workhorse of the financial world, it solves so many problems for us. Right. It serves as a really good foundation so that we can now invest much more strategically. Right. We don't have to take so much risk to catch up, because now we can actually make money in multiple places at once. Like when I do my real estate, for example, right? My money, I'm earning money twice. My money's growing in the policy, and I'm making a spread between how my interest costs and what I charge, the interest that I charge to do that deal. I'm making a spread. Okay. So even though I've incurred an interest cost, I'm making way more than that interest cost, just like the banks do, guys, where they pay us 1% in a savings account and then they lend it back to us at 4 or 5% for that car loan or whatever. That's exactly what they're doing. They're keeping a spread. You think they're bitching about the 1% that they pay us? No, because they're making 400 or 500% over here, lending it back to us. Okay. That's all we're doing here. All right. So here's the thing, is like, if I can do that, why on earth would I risk my money in freaking mutual funds? I don't need to, because I'm making 13% plus a point over here, and my money's compounding in the policy at the same time. Why on earth would I take so much more additional risk if I don't have to? It doesn't make any sense.
It doesn't make any sense. And now we're almost getting into a societal issue, Matthew, is that we live in an age of distraction. Okay, we're distracted from everything, and people look to I buy this stock or this crypto or this thing or this ETF, whatever. It's right. The thing is that anything worthwhile takes time and discipline, and I'm not against the market, but so much of this stuff, and the research which I'm coming out with some of the books, is that unfortunately the overwhelming evidence for individual stock pickers is horrific. I mean, I think it's there's a guy by the name of I don't know if I talked about him, but again, Henrik Bessenbinder out of the state of Arizona, and
what's his name?
He actually studies the return to the stock market, individual stocks, and really it's
Barry. Real quick, what was his name?
Bessenbinder, Henrik Bessenbinder, Bessenbinder, Henrik.
Okay.
He's he's essentially an economist, but he actually looked at this return to the stock market between like 1926 and 2019, and the whole thing is that if you weren't in 5 or 6 stocks, Matt, I mean, you kind of lost everything, and so we all want to have that. We all want to own that next stock, whether it be Johnson and Johnson or something like that, but we just don't know which ones it is. And
Right.
so the whole thing is the odds are really stacked against you. The house always wins. Wall Street,
Because it's a
the asset
casino.
managers always win.
Right.
You know?
It's a casino where the house wins.
Yeah, and
Right.
the thing is, and then but then I was the guy who said, oh, by the way, where does J.P. Morgan have a lot of its own assets in? Oh, high cash value life insurance. Where does Wells Fargo have their money in? High cash value life insurance. They have more money in high cash value life insurance than they do in all the real estate.
Right.
And I would
They buy
testify in
literally
court of law on that.
They literally buy billions and billions and billions of dollars of it every year.
Yeah.
So they sell us the trash so that they can buy the good stuff themselves.
Right? Yeah, and that's the whole thing. And I tell people too. By the way, banks. I don't know if we discussed it, but banks will not let bank regulators will not let the banks themselves put their own capital into stocks because it's too volatile. You know, so they make all their money gambling. You know, So this is the whole thing. Something like Morgan Stanley, they make 67% of their income. Okay, in trading stocks, wealth management, it's all rent seeking. Okay, is collecting fees.
Yep.
But you know how much Morgan Stanley has of their own pension in the market?
Nada. Because they get it, man. And here's the thing. I want to clarify a couple of things about this. And you mentioned this earlier, Barry, is that there's nothing necessarily wrong with investing in the market. If you want to do it strategically, and hey, you know what? I'm human. I have a little bit of a gambling itch that I got to scratch every once in a while. You know, that's fine. It's invest. Right. Exactly. You know, sometimes it's fun, right? But also it's what I mentioned there, it's fun. I'm not trying to get super wealthy with it. Okay, maybe I am, but I'm saying it's not at the core of my wealth building plan. It's not the majority of where my net worth is, where I think a lot of people, that's where their money is. It's in this Wall Street casino, in these mutual funds and stuff. It's like, there's thousands and thousands of mutual funds. How do you know which one is actually going to outperform the market? Because I'll tell you what, most of them don't. Most of them, you're paying all these fees for subpar performance, for them to not even outperform the market. Now, some of them will, but how do you know which one is going to do it? And now are they going to do it on a long-term basis? Most funds do not beat just the S&P 500. Now, here's the thing. When you have that information, and then if you want to change it up and now you want to buy maybe an index fund for the S&P 500, I think that's a step in the right direction. I'm still not a big fan of putting the majority of my net worth into the market to access 30, 40 years later. I want control of my capital now, but we're starting to move in the right direction, right? But I want to tie this back to one of my original questions, is why we can't do both. Why can't we have a good foundation with whole life insurance and then also invest in the market? Here's a potential scenario. Since people are, check this out, Barry, since people are so confident that the market's going to go up 8, 9, 10% on average, 12% if you listen to Dave Ramsey, okay? There's a potential scenario, not suggesting this, but here's an idea. What if you took the money that you were going to put into whole life or put into the market, you put it into the policy first, and then since you're so confident in the market, why not borrow against the policy, put the money into the market at that point, slowly pay back the policy loan over time, but you're earning money twice now. And you pay a little bit of simple interest on the policy loan, but now you have two assets. The reason people won't do that
you're in a much
is because they're not actually confident that the market's going to do that. That it's just going to go up, 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 and up because it's volatile, right? That's kind of my point. We don't know what the market's actually going to do. But if you're so confident in it, why not earn money in two places at once?
Yeah.
And you do both. Now you have a whole life policy as a foundation. You're still investing. Maybe you want to do real estate like I do. I don't know. It's up to you. Okay.
Well, I have an interesting statistic, which was going to blow everyone away, but I couldn't believe it. I stumbled upon this, and will be in one of my next books. Now, Wall Street is always coming up with new they're harebrained schemes for people to make money in a new mutual fund or ETF, all right? So they come up with these new products each and every year, okay? They come up with 5, 6, 700 different new mutual funds and ETFs every year, Matthew. All right?
That's a lot.
Now this is a stat, and this is, again, I would testify in this court because I got this from the Investment Company Institute, which is the lobbying arm for it's a nonprofit lobbying arm of the mutual fund industry. And over a 10-year period, Matthew, and these aren't I can't remember the exact numbers, but I'll be happy to give anyone who wants them. The mutual fund industry launched like 7,200 new ETFs and mutual funds over a 10-year period. All right,
they lost.
Are you with me? They opened that many new ones. Okay, are you with me? All right, that's like 500-600 a year over a 10-year period. Okay,
I got you. Oh, they lost.
Now, so they opened up 7,200.
Gotcha.
You know how many they shut down over the same period? Around 6,800. So that's like setting up, as a friend of mine, and when I said, Brian, that's like setting up 7,200 planes into the air and 6,800 of them crash. So this is, I couldn't make this stuff up. It's all true. So even they don't know what they're doing on this stuff, but it's all about marketing. It's like the ESG scam, which I'm finishing up the book on that now, is the environment, social governance.
Yep.
It was just big marketing.
It's all about money. Yep.
It was all about money. Marketing. It's just marketing.
Yep. And we touched on one of those examples of those funds shutting down in the last episode that we did, and you talk about it in your book. It was a Merrill Lynch fund, and it was during the .com bubble, and they started a fund in 2000, and then in 2001 they shut it down, and investors lost almost $1 billion, but they still collected. Merrill Lynch still collected $45 million in fees. So who's actually getting rich off of this stuff? I mean, I'm not saying that the potential isn't there. Could you get lucky and get the right fund? Sure. But how is that any different than gambling on something? Like, that's speculating. You don't know what they're going to do. All right. And if you want to do it with a small portion of your portfolio, fine, whatever. But if this is part of the long-term plan, I don't know. That doesn't seem like a very good idea to me. And, here's the thing. I invest a little bit in the market, but I do it very strategically. And I put money into an income ETF. So it's actually a cash flow producing asset. I'm not speculating on the long-term performance of the market. It's actually generating income every single month, right? And it has like, the covered call strategy, whatever. That's a separate video. I've done plenty of videos on that. But my point is, I do that very strategically because I already have my foundation, right? I got my foundation in place. I sleep really good at night. And now I can start to put money over here. It's got a really good yield. It's pretty, I would call, relatively safe because I'm not speculating on long-term performance. It's generating revenue, income right now, right? So it just comes down to, I think, doing things in the right order and also just being more strategic with where we put our money, not just assuming that Wall Street is going to build our wealth for us. If I just put money into a 401k and I diversify into a portfolio of mutual funds, which most people don't even know what they're invested in the first place, but I'm going to pick 4 different mutual funds. I'll have a bond index over here. It's like, why? Like, do you know why you're doing that? If you're being strategic with it, then fine. But if not, then how is that any different than going to the freaking roulette table and say, hey, give me I'm going to put 10 on 1, 2, 3, 4, and 5. Okay. Like, you don't know which one of those are actually going to do anything, guys. So I guess the point is to be more strategic with where we're putting our money. So
you have to think, because I like mutual funds are kind of like the slot machines. Slot machines are guaranteed, to make money. I mean, it's like the funds. They're just guaranteed to make money. It's all based on the float. and you have enough money.
Yeah, another mentor of mine, a new friend as well. I'm gonna have him on the channel pretty soon. His name is Caleb Gilliams over at Better Wealth. He wrote the book called The And Asset, and he talks about this. Talks about whole life insurance, and doesn't mention. Actually, I think he does bring up Nelson Nash in the book as well. But anyways, I love the term "and asset" for whole life insurance. Because
I know Caleb. I've spoken.
Oh, you do?
To
Okay.
I've
Nice.
spoken to him.
Nice.
I have hope in you guys. He's a great young man.
He's awesome, man. I freaking love that guy. And I love that term, the "and asset," because he talks about this a lot, especially in his book, where we don't have to necessarily choose either or. We can do both whole life insurance and make investments. That's kind of the point of, or one of the aspects of infinite banking, is being able to do both, because we put the money into the policy first that we were going to use for buying the car, making the investment, or whatever. We put the money into the policy first, so that will continue to compound for the rest of our lives. But now we have control. So we get compound and control. We can borrow against that. We're going to incur a little bit of simple interest, but it's worth it to make money in two places at once. And then whatever your normal wealth, whatever you would normally do to build wealth at that point, you can still do it, right? As long as you're disciplined, you're able to save money on a regular basis. You're actually going to pay the policy loan back, which let's wrap up with this, I guess, because we're coming up on the hour here. I want to be respectful of your time here, but I think this is a good way to wrap this part of the conversation up. Some people would push back again on the idea that you're paying interest. Like, why are you incurring an interest cost? That doesn't make sense. Well, it actually does, because you're earning money in two places at once. But here's the other thing, is when you're paying that policy loan back, that is almost the same thing as putting money back into a checking or savings account to make another round of investments the following year. Let me break that down really quick. Okay. Let's say I've got $10,000. All right. And I'm going to put it into an investment. All right. Whatever. And let's say I'm going to do that over the course of the year. Once a month, I'm going to dollar cost average into whatever that investment is. All right. Okay. Well, I had to save up the $10,000 in the first place. I had to put $10,000. I had to accumulate 10 grand into this account so that I can now make that investment. Okay. Well, when we flip the script here and we put the money into the policy first and we borrow against it, okay, when you're paying back the policy loan, it's just like putting money back into the checking or savings account that you would anyways to make another round of investments the following year. Yes, you're paying a little bit of interest. Okay, that's the main difference. You wouldn't pay interest in the savings account. But again, you incurred massive lost opportunity costs by liquidating that account, putting it into the investment. Whereas if I put it into whole life insurance first, that money's compounding for the rest of my life. I'm going to put the money back into the policy. Once I've done that, I borrow against it again and rinse and repeat the process. The only thing it costs is a little bit of simple interest. That's it. And I guess the question would be, is paying a little bit of simple interest worth earning a significant amount of compound interest for the rest of your life? I think that's a rhetorical question. I think it's a very easy question to answer. The answer is yes. Not everybody sees it that way. And maybe it's just a lack of understanding of how the strategy works. I don't know. But the point is, this is an and asset. We can do both. You do not necessarily have to choose one or the other. Do I put money into a whole life policy and sacrifice my investments? Or do I do buy term and invest difference? How about we just do both? How about we figure out a way to do both? I don't know. Call me crazy, but it seems to make sense to me. I would love to hear your guys' feedback. I know I'm going to get some interesting comments on this stuff. I always do when it comes to infinite banking, but it is what it is. I just know that it's kicking ass. It's kicking
my newsletter. One of the things which people, if they want to go to barrymajamesdyke.com and we'll put you on our newsletter, and we'll let you keep you up to date on this stuff as well.
Yeah. We'll I'll put that link in the description. You guys can connect with Barry, get on the newsletter. Make sure you get his books as well, especially Pirates of Manhattan. You got Retirement Ruse out as well. That's going to be really, really good. So make sure you guys get that. And, just be more intentional with your money. Just ask questions, right? Not saying that everybody has to do infinite banking, but how do you know this isn't going to be for you if you don't at least do your research, right? I know that this strategy has been kicking ass and taking names in my business. I just helped, or in my life, it's been a game changer for me. I consolidated 2 people who are close to me. I consolidated all of their credit card debt as well. And guys, it doesn't impact me at all. Because guess what? My money's still growing in the policy. And yet I was able to help 2 people that I love and care for very much to put them into a better financial situation. It put so much money back into their pocket every single month. Obviously, it's really good for their credit. It's good for their peace of mind. And then they just pay back the policy loan with interest. It costs me nothing to do that. I can't tell you how satisfying that is. It makes such a huge impact in not just your life, but other lives as well when you start to implement stuff like this. So
yeah, good.
Please look into
good
it, guys.
Work, man.
Yeah, thank you. So Barry, we'll go ahead and wrap up there. Like I said, I want to be respectful for your time. Man, it's always a pleasure. I've really enjoyed our conversation so far. I can't thank you enough for your time. I really like to try to get other people's perspectives on these things on my channel. So I really appreciate you being here. I hope you'll join me again for another conversation at some point in the future. Make sure, guys, that you get on Barry's newsletter and connect with him. It's got awesome stuff. Barry, any final words for the audience that you want to share? Anything that you want to cover real quick that we didn't cover?
No, I'm just finishing the words of one of my mentors, Nelson Nash. Just keep going, man. Keep pushing back the frontiers of ignorance.
I like it. That's a good way to put it, man. All right, brother. Well, I really appreciate it, and looking forward to the next one. All right, take care.
God bless. Bye-bye.